Wherever you are on your road to retirement, we're here to help you stay on course. Welcome to Mason Street Retirement Insights, the show dedicated to helping you plan your financial future.
What is your biggest concern? People are very focused on the amount of money that they have saved, but it's really about the income that we generate. Income is what's going to drive lifestyle. And so the income strategies that we utilize are what's key.
And now, here's your host, Sean Mason.
And my name is Casey, and I'm here with Sean, asking for his ideas on what you need to know, what you can be working on as you get closer to your retirement goal line. After decades of working and saving, now Sean is here to help make that money work for you in return. So as you're listening today, if you have questions for us, give us a call. Let's set some time on the calendar for you to talk directly with Sean. 559-847-0039 is our phone number, or you can also get connected on the website anytime. We are at Mason Street retirementinsights.com. Sean, my friend, great to see you. How are we doing this weekend?
Hey, everything's really good. Good to see you, Casey, and so happy to be hanging out with my community.
Well, I'm going to pick your brain on some retirement talk. I mentioned a little bit earlier, giving us a call. If somebody has questions for you, if somebody's interested in getting their retirement conversation started with you, you've got your introductory retirement planning assessment on the table today, right? So I want you to tell us about that process and what people can expect if they pick up the phone and they give us a call today.
Yeah, it's just such a great kind of a process experience to go through. When you're in that position to where you're kind of thinking about retirement or even in retirement and just trying to make sure that you're going to make it as great as you possibly can, want to put yourself in the best possible position. There are some different things that you need to be thinking about. You need to identify that there's elements out there that we got to make sure that we understand. And so coming in for a planning assessment really gives me the opportunity to talk with you, kind of get to know you, understand what's important, what you're trying to accomplish, what your concerns are, and then we can talk those out. I may have some great recommendations that you can use on your own to put yourself in a better position. And we might find that we have an opportunity to work together on some level. So it's just a great discussion for you to come in and get some additional wisdom and knowledge about this next chapter that you're embarking on.
559-847-0039. A no-fee, no-obligation retirement planning assessment with Sean is waiting for our listeners who have $500,000 or more saved for their retirement. This phone call you're about to make is what will get the ball rolling on that planning assessment. You'll be able to connect with one of our Mason Street teammates standing by, and then they will help you find a time on the calendar that works for you to talk directly with Sean. 559-847-0039, or we are online as well. You can head to Mason Street retirementinsights.com. You'll click that Contact Us tab and just fill out your information really quickly, and then we will have a teammate reach out directly to you. All right, so a few things I want us to cover on the show today, Sean, and I feel kind of like our theme is going to be turning all those years of saving into something that actually works for you in retirement. And one of the easiest places, I think, to start that conversation is with money that you may not even be expecting, because thanks to recent changes in tax laws, including a $6,000 senior deduction for those ages 65 and over, you might be in store for a higher refund. We've got Jill Schlesinger with CBS News talking about this. Take a listen.
Well, it's because of those new tax law provisions and a larger standard deduction. And a lot of people were withholding based on the old rules, which means they probably over withheld. So what does that mean? We saw last tax season refunds averaging over $3,100. And we could see that rise towards $3,500, maybe even $4,000, depending on your situation.
So, Sean, we could always spend that extra money, or we could sock it away in an emergency fund. But I'm curious, if somebody wants to use it to make more of a tax impact on their retirement, what could they do with it? What are your thoughts here?
Yeah, it's been really fun. I mean, we've already identified several situations where people are getting a significant higher tax refund this year. I met with a couple last week who just booked a trip to Hawaii with their tax refund. I like that idea. Let's go.
Mm-hmm. I'm down.
Yeah, for sure. But, you know, there's many strategies we can use. Those extra dollars, it's important to think about that those extra dollars are coming to you tax-free. So contributing to a Roth IRA could really help your long-term tax plan. maybe you're not in a position to be able to contribute to a Roth, maybe because of income thresholds, or you retired and you don't have earned income. In that case, think about contributing those dollars to an investment-grade life insurance account. It's just another great tax strategy, and it can be designed to provide long-term care funding, legacy for kids or grandkids, in addition to tax-free income.
So you're talking about using these extra dollars in a more strategic way. And I know one strategy you just mentioned, we talk a lot about it on this show, is Roth conversions. And this kind of seems like a perfect opportunity to connect those dots. So how could this tax refund actually help somebody make their Roth conversion a little more effective for them?
Yeah, it's a really good question and a great opportunity. I would be suggesting to think about using those dollars to pay the taxes on a Roth conversion. At first glance, that doesn't sound real exciting, to send the money right back to the government. But conversions can have a powerful effect on your tax plan. And when converting money from a tax deferred account, the 401k, the IRA, to a Roth, most often a portion of those dollars are withheld for taxes. But if you use outside funds like your tax refund, it can increase the long-term tax benefits significantly. And Casey, it's good you brought up the tax planning aspect, because it's so often overlooked in retirement planning. For most of us, the goal is to get as many spendable dollars out of our resources as possible throughout our lifetime, and then pass what's left to who we care about and not who we don't, which is usually the government in a form of taxation. And taxes are the biggest erosion factor to that goal. I meet with CPAs quite often. We walk through tax strategy. We walk through Roth conversion and tax loss harvesting strategies. CPAs are usually great at helping us reduce taxes in the current year. Mm-hmm. But for most people, the amount of taxes they pay over their lifetime is what's most important. And that takes advanced tax planning.
Yeah. So I'm wondering if you could maybe give us an example of a client that you help them use their tax refund in a strategic manner like we've been talking about.
Yeah, for sure. And there's been a few. Jim and Joellen, they came in just about 2 weeks ago. And we were talking about tax planning for the next year, and they brought up the fact that they were getting a pretty significant tax refund this time. Joellen's 60, she turned 65 last year. Jim turned 66 last year, and he is very excited because he is right now retiring. He retired in January. He's been a correctional officer for 30 years. They're both going to get that extra $6,000 senior deduction. And Jim, because he's a correctional officer, really has an opportunity for a lot of overtime. And he did put in a lot of overtime last year. And it just so happens that one of the benefits of the big, beautiful bill was no taxes on overtime. And so he's going to get quite a significant tax refund this year, and they're going to use that tax refund to pay the taxes on a Roth conversion. And we figured out that Roth conversion is probably going to benefit them in the way of about $30,000 in tax-free money in the future. So it's been a really good journey walking through the different opportunities with people because of the new tax law. But Casey, these tax strategies we've been discussing require advanced calculation. And there's no, one-size-fits-all plan. We have to individually tailor to each situation. So I want to invite our listeners to come into our office for a retirement planning assessment. Investments, your estate planning, tax strategies, all those elements you have to be considering. And for our first 5 callers, we're going to do this with no cost. And then for the first time ever, we're going to include our Roth conversion analysis. It's just a great opportunity for people to get insight into how this powerful tax strategy can benefit you individually. So I really encourage you, give us a call right now. Call us at 559-847-0039. Our team will find a convenient time for you to come into the office or meet by Zoom if that's better for you.
559-847-0039. If you don't have a plan for how your tax decisions today affect your retirement tomorrow, you're not alone, but thankfully that is something that you don't have to figure out by yourself. 559-847-0039. That's the number you're dialing right now if you have $500,000 or more saved for retirement and you are ready to secure your spot for your very own introductory retirement planning assessment with Sean. And today only, first time ever, also that Roth conversion analysis that Sean is offering to you. 559-847-0039 is how you get the ball rolling, or you head online to MasonStreetRetirementInsights.com. So, Sean, that refund we were talking about could be more than just extra money for people. It could be a strategic move that helps them out later on, especially when taxes become a bigger piece of the retirement puzzle. But here's where a lot of people, I think, get stuck. Even if they want to do the right thing, they're looking at this market and they're thinking, is now really the time for me to invest more? Which brings us to something I found very interesting, because most of us are just regular people with a 401k trying to make the right decisions for our retirement. And according to a new study, it was done by Albright Solutions, us retirement savers, we see the economy differently than those on Wall Street. This study found that people who frequently buy and sell stocks, they are plowing money into the market. But us retirement savers, we are moving in the other direction towards cash, bonds, and fixed income. So, Sean, for those who are running for safety here, I'm wondering if you think they're being smart or maybe if they're potentially missing out on a really big opportunity. What are your thoughts?
Well, a big part of that answer is going to be based on why they're running to safety. But it's a great question, and because of the economic environment we're experiencing right now, it really deserves the attention. Usually this is a risk tolerance discussion, and rightfully so. We're all looking for a stress-free retirement, but we're really in exciting times. I mean, there's opportunities popping up constantly. Things are moving fast, which can cause anxiety. You know, FOMO, fear of missing out, fear of making decisions. And yeah, equities have ruled the markets for over the last few years, but we also have to consider the unique interest rate environment we're in and be aware of opportunities that can come along with it. You know, bonds, they make up the lion's share of fixed income asset classes and are heavily affected by interest rate movement. And history has shown that when interest rates increase, the bond values decrease, and then when interest rates go down, often those bond values go up. And we just happen to be in a very high interest rate environment right now, at least compared to recent times. So those that are paying attention can find an opportunity to capture some bond value increases if interest rates start to decline significantly. And Casey, it's important to note that I'm not suggesting anyone can time the market. There's no crystal ball.
Well, right. So I'm curious, so if people are moving toward fixed income for that peace of mind, which makes complete sense, how do you help them avoid becoming too defensive and potentially missing out on opportunities elsewhere?
Yeah, it's a great question. And I would say being aware of momentum trends could prove to be really beneficial. But, you know, with all that said, I would guess most of those people who are moving towards fixed income are feeling, you know, a little bit uncertain and maybe concerned. I'm sure the media has a lot to do with it. They all have their biased spin, often politically driven, rarely data driven. But those who have hung in there with equities have been rewarded for sure. And the equities opportunities have been broadening, meaning technology, especially the Mag 7, you know, focused on AI, have really carried the weight for the last few years. But we're seeing growth being spread out to other sectors. And this is really important to be aware of. You know, stock prices of the major tech players are extremely high. Investors may find value in lower prices within other sectors. And we're hyper-focused on those sectors and companies that are not necessarily in the AI category, but will significantly benefit from the advancement of AI technology.
Okay, so what can those that are concerned do to protect themselves but also still capture growth?
Yeah, I think coming to grips with, who you are as an investor, you got to get real with if you should be managing the money. Do you have the skill set to be suggesting that the family's lifestyle and quality of life could be affected by the decisions you make? If not, then, you got to find a good advisor. I would suggest if you're getting close to or in retirement, you got to find a phase 2 fiduciary advisor. They're going to be more equipped to deal with you moving into retirement. But if you are going to be the one to be the family investor, then you just got to be paying attention, because there's lots of opportunity. You got to be able to identify those opportunities. You got to be paying attention again to those trends. The momentum in different asset classes is key. And you've got to eliminate the emotion. There is no room for ego, and there's no room for fear either. Ego can contribute to significant losses. And what I mean by ego is sticking with something because you want to be right. It does not matter if you're right or wrong. It all matters about what happens in your investment accounts. And having fear of moving forward or having fear of making decisions, that could create huge losses for growth. That could create huge losses of opportunity. So you got to be real careful with your emotions. And then consider that there are risk mitigation strategies well beyond fixed income. We're looking at fixed income right now for growth opportunities, not risk mitigation. Think about strategies that can be utilized within equities that maybe have stop losses, maybe have some safety nets that you can utilize to mitigate risk on its own.
559-847-0039. I know that there's no one-size-fits-all answer here because everyone's situation is different. So if you're listening, you're wondering, am I being cautious or am I leaving opportunity on the table? That's exactly the kind of conversation you can have directly with Sean. 559-847-0039. We've opened up a few select spots on the calendar for our radio listeners who have saved $500,000 or more for retirement. We've opened those spots up for your very own introductory retirement planning assessment. Plus, today, only that Roth conversion analysis. So give us a call right now. Let's set a time to begin the conversation with you and Sean. 559-847-0039 or online at masonstreetretirementinsights.com. Now, Sean, I want to dig a little deeper on risk. I think that's the real tug of war here. People want to feel safe, but they don't want to miss growth at the same time. And underneath that is a bigger question that we don't always say out loud, but it's how much risk is somebody truly comfortable with when it's their retirement on the line. There's a brand new study that I wanted to chat with you about that basically proves that there is a gap between what retirees think is acceptable versus what advisors assume is acceptable. It was a study by Capital Group that looked at almost 6,000 retirees and 600 financial advisors with the goal of taking a closer look at risk. And here's what it found. It said advisors were comfortable with a 30% loss in client accounts if it meant longer-term growth. Retirees, on the other hand, said they were willing to risk only 15%, even if that meant an upside of 50%. So my question here, Sean, is do you talk to people who felt that their advisor was pushing them towards more risk or found more risk than they thought?
Yeah, actually, I see that all the time. In fact, actually, it's more often than not. And I read that article as well, and I found I was really happy that they did that study because this is one of those concepts that is overlooked by financial advisors, and probably in part because it's overlooked by the industry as a whole. It's really a discussion about the skill set of the advisor. And of course, that's assuming the investor is working with an advisor, because if not, they're taking it upon themselves to understand risk. Unfortunately, most view risk from pure emotion, which can really be detrimental to, lifestyle, quality of life, and then ultimately financial security. But a great advisor will educate the individuals they work with about what risk, truly is. Most people think risk is, conservative, being moderate, maybe being aggressive, but it goes so much deeper than that. And without the understanding, it's tough for a family to know their risk tolerance. When I ask people, what rate of return do your accounts need to make so that they can provide the lifestyle you're hoping for without running out of money, they rarely know. I'll ask, if a major market correction happens, how long of a recovery period? How long does it have to take? How long can your accounts handle that before they start taking permanent losses? And then I'll also ask, what are the opportunities during a market correction? These are all examples of practical discussion around risk. And it's essential to know the answer to those. But emotions are also very important. When I ask a family how much they're willing to see their accounts drop at any given time, they'll usually say a percentage. I'm willing to go down 20%, but then I'll ask that question in a different way, and I'll ask how many dollars they're willing to watch their accounts drop. Usually the answer becomes half of what the previous answer using a percentage was. So perspective is key. It's the advisor's obligation to educate and communicate that practical aspect of risk, and then discuss perspectives so that families can make more informed decisions about what their true risk tolerance is.
So what do you think people should be considering in determining their true risk tolerance?
Yeah, it comes down to education. You've got to get educated on risks, or engage with a great advisor that understands risk to a deeper level than maybe you do on your own. You've got to understand the investment risk compared to income risk. There's a lot of strategy in how you take income, and there's a relationship between your investments and your income strategy, and you've got to get clarity on that because they're both affecting each other all the time. There's strategies where we can implement guarantees to where we have no market volatility concerns at all for a portion of our portfolio, which could also mean a portion of our income. And then we can also implement strategies that we're really relying on probabilities, which is probably more market-oriented. We know the market's a roller coaster, and we're going to have times of volatility, but the probability suggests that the majority of the time the market is up, and so we have to understand how to work between those two. Time horizons for each dollar, it's essential to understand that. The longer it is until we're going to spend a specific dollar, the more aggressive that a dollar could be invested. We can position risk so that risk and volatility does not affect our lifestyle, but it does give us that needed growth over time, and we can absolutely structure risk so that we can be successful there. We also got to be really aware of what the consequences of our risk is. Understand what that looks like, but then at the same time, recognize that there's opportunities in market corrections, and we want to position ourselves so that we can take advantage of those opportunities at any given moment.
We have opened up a few select spots on the calendar. Sean does that every week for our radio listeners. So I just want to remind you right now, if you've saved $500,000 or more for retirement, we encourage you to give us a call right now and reserve one of these spots for yourself. 559-847-0039. You can have a conversation with Sean about the life you're living now, the life you hope to be living in the years ahead, and then he can explain to you some of the processes, some of the things that they do at Mason Street Wealth Management, and how they might be able to help you put it all together in a plan for your future. Whether you live to 75, 85, 95, 105, you want to know that you're going to have that income coming in. And so does Sean. He wants to work with you on that plan with and for you. So let's start with that conversation. Give us a call right now. We will get a time set on the calendar, 559-847-0039. You can also go to MasonStreetRetirementInsights.com and click on the button that says contact. And It's very easy to begin that way as well. Or I think the easier route is to just give us that call right now, 559-847-0039 to schedule your very own introductory retirement planning assessment with Sean. Plus, today only, first time ever, he's offering you his Roth conversion analysis. Don't miss out. We'll give you a few minutes now to make that call while we take a quick break, but don't go anywhere. Lots more still ahead here on Mason Street Retirement Insights. We'll be right back.
Welcome to Willie's Wings, home of the secret sauce.
I'll take a dozen wings. Oh, by the way, I love that sauce. What's in it?
Can't tell you.
Why not?
It's a secret.
While many financial advisors claim to have the secret sauce, they don't. In fact, if their sauce is so good, why are they keeping it a secret? Sean Mason of Mason Street Wealth Management doesn't keep anything a secret. He knows there's much more to retirement planning than stocks, bonds, and mutual funds. He'll develop a strategy designed specifically for you. It's your own secret sauce for retirement. Call Sean Mason at Mason Street Wealth Management for your personal portfolio x-ray. Call 559-847-0039. That's 559-847-0039. Or online at masonstreetwealthmanagement.com.
Fine, you want to know what's in the sauce?
Absolutely.
Tablespoon of paprika.
Really?
You have found Mason Street Retirement Insights. My name is Casey, and I am here with my buddy Sean Mason, president of Mason Street Wealth Management right here in Fresno, asking for his ideas on things that you can be working on as you get closer to your retirement. As you are listening today and you've got questions, want to remind you of our phone number. That's 559-847-0039. You can schedule some time to sit down with Sean for that introductory retirement planning assessment. 559-847-0039. Or we are also online. That website's masonstreetretirementinsights.com. All right, time for some retirement talk, Sean. Let's get into the good stuff. If you are a listener to this show, then you have heard us talk about risk tolerance. But how do you define it? Well, here is Carrie Hannon with Yahoo Finance. Let's take a listen to what she had to say.
It's really how much you can stomach when the markets drop. Are you going to freak out? Are you going to panic? So this is sort of this moment where you have to sort of take a breath and really be honest with yourself. How can you handle the drops? And we see these all the time. And can you wait it out for it to come back? So if a 10% drop is going to make you crazy, then you're not very risk tolerant. But it's important to understand that because this is going to tell you how much you want to be in the stock market, invested in equities, or in cash and bonds, which is a little more steady, and you're not going to have these ups and downs.
So that's the definition. But Sean, I want to ask, how do you go about measuring a client's risk tolerance? Does this conversation happen during that first meeting? Talk to us about this.
Yeah, and risk tolerance, it's a really unique element of the planning process. It seems so simple on the surface, but absolutely deserves a deep dive because it can affect quality of life for the whole family. We have to distinguish between emotions and pragmatism in the risk tolerance discussion. Both are equally as important, but how a person feels can be different from what is best for their situation. If the thought of market losses makes you feel uncomfortable, but then if you learn that a temporary loss won't affect the expected lifestyle, now maybe we will feel less anxious about those losses, and that understanding might change our feelings about our true risk tolerance, allowing for maybe a more growth-oriented portfolio. But then on the flip side of that, if we have a high risk tolerance and we're always looking to chase those higher rates of return, but then we learn that those above average returns are not necessary to serve our lifestyle goals, maybe we'll feel a little more comfortable with a smoother investment experience with less risk. And so establishing those practical risk tolerance is a key component of our comprehensive planning process. Stress testing the effects of possible adverse life events is critical. And Casey, it's worth knowing that this perspective is paramount when two spouses have a wide variation of risk tolerance. Walking through this process will help bring them closer to alignment.
Well, I know you know this, Sean, being in this business for a long time, that life kind of has a way of throwing us these curveballs, whether it be a good thing or a bad thing, whether it's a new job or you're growing your family or an unexpected inheritance or there's a change in the market. Things are always changing, and those curveballs can all shift how comfortable we feel with risk. So let me ask you this. How often are you sitting down with clients to revisit their risk tolerance? Are there, let's say, certain life changes or events that make you say, hey, guys, it's time we sit down and we talk about this again?
Yeah, Casey, what a great question, because risk tolerance needs to be assessed at least once a year, and for multiple reasons. Long bull markets can lull us into a false sense of security. Just as sure as a sharp decline can create fear, media rhetoric, our investment guru we meet at the office water cooler, they can all weigh on our emotions. So it's really important to take inventory and remember what's important. But there are life events that might cause pragmatic change in risk tolerance as well. Long-term health care, market declines, an early death. The loss of a spouse can cause income risk because of Social Security and pensions. Just the other day, Cheryl, she's 62, and her husband, Henry, passed at a young age of 68. She lost half of his pension and all of his Social Security. This was a significant change in her guaranteed income. And she wasn't willing to rely on markets to replace it. So we helped her use the life insurance proceeds to purchase what's called a private pension. And it replaced that guaranteed income she lost from Henry's passing. This is another example of why planning is so important. And I want to extend an invitation to our listeners. And you got to do it now, because for the first 5 callers, if you've saved over $500,000 for retirement, I invite you to give our team a call, and we'll help you with a retirement planning assessment. It'll include those tax strategies, the income planning, the risk assessment we've been discussing, and we'll do all this complimentary. It's that important. So give us a call at 559-847-0039 or go to masonstreetwealthmanagement.com.
Well said, Sean. If you are looking for those answers to your retirement questions, this is the perfect chance for you. Connect with Sean, sit down with him. There's no pressure. There's no commitment, just genuine guidance that is tailored to your specific situation. But like he said, spots will fill up, so it's time to take action. We are standing by now to take your call. That number for you again is 559-847-0039. One more time for you, 559-847-0039. Or, of course, if you prefer online, you can always find us at masonstreetwealthmanagement.com. Now, Sean, I feel like delaying retirement is a really hot topic right now. I feel like we've actually been talking about it on the show a lot lately. And if you're about 10 years away from when you think you'll retire, you might be looking closely at how much you've saved so far. And if you're not happy, like many aren't, Yahoo Finance's Carrie Hannon says, plan for ways to bring in more income. And one option is to work longer. Let's hear what she had to say.
I'm not saying pedal to the metal. It doesn't have to be. People who retire at 65, my goodness, you could have 2+ or 3 decades in retirement. So this is something to consider as an ongoing way to bring in some income as you approach, kind of tip your toes into retirement full time, right? So a lot of people may inch into this. They may work part-time, consulting. There are lots of ways to slice and dice it. But the point is, start thinking 5 years in advance about what that might be.
So that sounds good in theory, Sean, but I wanted to chat about what happens when that decision isn't up to them. How do you help your clients prepare a plan B for an unexpected early retirement? What's that process like?
Yeah, it does sound good. And so families come into my office, and when I ask them what their concerns are, they'll often say, I don't know what I don't know, meaning they understand how important it is to get this right, because when you give up the paycheck, there's no safety nets. And they don't want to find themselves in a situation they didn't think of and could have planned for. This is one of those areas most people don't think about. There's an organization called the Employee Benefit Research Institute. They do a lot of great work that's valuable to us for planning purposes. But each year they conduct a study, and not each year, every few years they conduct a study, and they poll 60-year-olds. And they ask them if they plan to retire before or after age 65, and the results are very consistent. 2/3 say after 65. And then they pull the same people at 67, and again, the results are very consistent. It ends up that 2/3 retired before 65. And there's many reasons why. I'd like to say they come to see me, and through comprehensive planning, they figured out that they had the resources to make that decision on their own terms. And that happens often.
Yeah, that's what we love to see, right? That's what we want to happen. But as you and I both know, Sean, that's unfortunately usually not the case, right?
Yeah, and as you said, usually it's circumstances out of their control, health issues, either with themselves or sometimes family members. Often the employer management team changes, making it unbearable for the employee. We see that a lot. Or sometimes the company just wants to replace the old guard with the new guard and pay them less. I've found through the 20 plus years of working with families going through these situations, the fear of the unknown sets in, and it's crushing to the soul, and that's for good reason. You know, they thought they had their retirement figured out, and now it's completely derailed. And when that happens 2 or 3 years earlier than planned, it can have a significant effect on their lifestyle in retirement. This is one of those reasons why you hear me say over and over, those families who have comprehensive financial plan in place right now will be so much better off. It can eliminate that fear of the unknown. You know, knowing consequences of the many hurdles that can hinder retirement lifestyle allows us to intentionally plan for them and mitigate their effects.
When retirement happens 2 or 3 years earlier than planned, that moment can feel so overwhelming for people. And there's so many emotions and decisions that are coming at you all at once. So let's kind of walk listeners through this, Sean. When you sit down with a client who's just found out they have to retire earlier than they planned, what's your process? Where do you begin? Do you start with their cash flow? Do you start with insurance, Social Security? What is step one when this happens to a client?
Well, no matter what the situation, we've got to figure out, what's important to them, who they are, what they're trying to accomplish, and what their concerns are. And then we got to start to plan from there. If a family comes in and they are all of a sudden in the situation to where they have to retire earlier, typically they don't have the resources that they were hoping for, and we're going to have a limited lifestyle. We've got to take into consideration their risk tolerance, the longevity, what we're expecting. So there's a lot of different elements that we have to take into consideration, but stress testing. What happens in certain situations? We got to make sure that we understand that what types of hurdles, what types of potholes can come, plan for those so that they don't find themselves in another unfortunate position.
Well, and just as important, what are some of the first things you would advise them not to do in those first 72 hours that they find this out? Because, sometimes people act on impulse and they might make a crazy big decision that then they can't take back. So what would you tell one of your clients not to do? What kind of hasty decisions would you say? Hey, take a beat, take a breath. Let's not act crazy.
Yeah, it's a really good question, because if I'm already working with them, they already know not to have any emotional decision making.
Okay.
But for people that aren't working with me already, you cannot panic, and you can't make decisions based out of emotion. So you've got to think through it. I always suggest get some professional consult. There's nothing wrong with doing that. It doesn't mean that you don't have it together. It just means that you're trying to improve your situation.
Yeah. I mean, at the end of the day, you don't want to be caught off guard. It all starts with having that plan set in place, and putting that plan in place all starts with a phone call. 559-847-0039 is the number that you're dialing right now. We've got a teammate standing by off the air, ready to answer your call. Let's set a time on the calendar for your complimentary retirement planning assessment with you and Sean. This is a no fee, no obligation first step in the planning process. You guys can connect on Zoom or in person, whatever you prefer. Sean can make it happen. 559-847-0039 is that number to dial. It's just a space for you to ask some questions. Explain to Sean what you are worried about, and then he can share with you his ideas on ways that he and the team might be able to help. You can also always go to MasonStreetRetirementInsights.com to get started. You can click on the Contact Us tab and fill out your info for us, and we'll have one of our Mason Street teammates reach out directly to you. Or what's easier, I think, is just giving us a call right now. Let's set that time on the calendar. 559-847-0039. 559-847-0039. Earlier this week, a friend of mine sent me an Instagram post that talked about various fears or phobias. One of them was called Plutophobia, which is the fear of money. So, of course, I went down the rabbit hole and I read that this can manifest during retirement in the fear of spending your savings. And what's one way to overcome that? Well, this article talked about one tool that helps increase certainty. So, what do you think they're talking about here, Sean?
Well, and it's a real thing, Plutophobia. We don't run into it often because people that suffer from it typically have trouble accumulating wealth throughout their life. But it has come up a few times with people, especially who had recently inherited significant amounts of money. But that fear of running out plagues so many of us, maybe not to the level of Plutophobia, but it certainly interferes with lifestyle and quality of life. And often this affects a spouse who wants to live their greatest life, but are being held back by their spouse's concerns of running out of money and not having enough. The good news is there's a fix. You've heard me say so many times, going through our comprehensive planning process, it helps people see the reality of their situation, and then it exposes them to income strategies that can completely remove those fears and concerns of running out early. It really boils down to the income strategy that'll be the best fit. We've been told for years that we're financially prudent if we take 4% a year out of our accounts that are invested in the market and that will never run out of money. There's a lot of risk. That may or may not work. You're hoping the market performs to suit that strategy. It relies heavily on what's called sequence of returns, hoping the market delivers positive returns in the earlier years of retirement. Most of us want more certainty that our money will last. And there are income structures guaranteed and insured by A-rated insurance companies with multiple layers of protections. So some families might want to guarantee income to maybe cover their core expenses and then rely on the market for lifestyle desires. Some want to guarantee both and then use the market to grow the rest of their money long-term for healthcare expenses and eventually legacy. I've found that when families have the right balance between guarantees and taking risk in the market, they feel more secure to spend and live that lifestyle that we're hoping for. We can design and tailor an income plan to suit a family's needs and lifestyle desires. Risk tolerance, flexibility, short-term versus long-term spending, taxation, these are all aspects we need to consider in that income plan design.
Yeah, I mean, it's always inspiring to me to hear how someone finds that confidence to enjoy their retirement that they've worked so hard for. And sometimes it really just takes that one moment or that one strategy to help them break through those worries. So have you ever seen a client make that leap, Sean, moving past the fear of spending in retirement and what, made the difference for them?
Yeah, Casey, that aspect you bring up of fear of spending, it's just no way to live your best life. And we deserve to have both lifestyle and security. And we can. Jared came into our office. He wanted to come in separate from his wife, Carrie, for the first visit. We don't usually do that, but he really talked about the need. And he explained that Carrie was having a hard time being confident that they could buy the cabin at the lake, which they had dreamed of for years, but then still continue that same lifestyle they were accustomed to. And they had some bucket list items that were really important to both of them. When Carrie came into the next meeting, I asked her to tell me what was important to her. Through that discussion, we identified that the issue was having to rely on the market. She said they lost over 30% of their savings in 2008, and she just knew that could happen again. So we created a net worth and cash flow analysis based on their current situation, and we tested how they would be affected in the event of a severe market correction. And I'll tell you, she was right. It would significantly alter their lifestyle and put them in jeopardy of funding future healthcare needs. So using specific investment and tax strategies, we were able to design an income plan that guaranteed the income they would need to cover the cabin expenses. It gave them the money they would need to check off those bucket list items over the next 10 years of retirement, and then ensure they would continue the same lifestyle they were accustomed to. They were both comfortable with relying on the market to fund those long-term expenses like long-term health care, and they figured the cabin would be the safety net in case they lived longer than they planned for, or be the legacy to the kids along with their residents. Jared just emailed me letting me know they found the perfect cabin and put an offer in. I got to tell you, Casey, it's just so fun to see them so excited.
Oh, that's amazing. You love to hear it. I mean, that fear, it's true. It can keep you from enjoying the very retirement that you worked decades to build. And that's exactly what we do not want to happen. So if you're wondering whether you're being too conservative with your spending, or if you just want to know what is safe to spend without jeopardizing your future, Sean is here. He is eager to help. So give us a call. 559-847-0039 is that number for you. Claim a spot on Sean's calendar. Get that complimentary introductory retirement planning assessment that he's offering you. You guys can walk through your income sources. You can walk through what your goals are. And then together you can work to build a plan that's going to work for you and give you that confidence that you've been looking for. Our number for you again, 559-847-0039. One more time so you can write it down, 559-847-0039. Or you can always visit us online. We are at MasonStreetRetirementInsights.com. Retirement is drawing closer for Gen Xers. The oldest in this group are now 60. But an article I saw this week at usatoday.com was titled, For Gen X, Retirement Bites. It said that Gen Xers don't think they've saved enough for retirement. Gen Xers wish they had started saving sooner. They fear outliving their savings. And they're also worried about a stock market crash because they lived through the Great Recession. So, Sean, with the oldest Gen Xers now just 5 to 10 years from retirement, what do you say when they confront you with the uncertainties that they have about their retirement?
Yeah, right. And I read that article too. I don't know that. Oh, and by the way, I'm a Gen Xer. I'm on the older end of the generation. But I don't think these concerns are necessarily limited to any specific generation. Through the 22 years of working with people on their financial situation, I've learned that we go through phases of concerns based on our age. And most of us, somewhere in our late 40s, maybe early 50s, we start to recognize there will be another chapter. And we call that retirement, probably because we're watching our parents in retirement. And Gen Xers, they just happen to be in this phase right now. They're reaching out to us every day for consultation because of those concerns you mentioned. And for good reason. It's essential to know how long your savings will last and how taxes and the market are going to affect your income that you generate from your savings. Mistakes in projecting inflation can significantly reduce your lifestyle or put you in jeopardy of running out of money too early. So there are many elements you have to plan for.
Yeah, I know that these are conversations that you're having every single day in your office, Sean. And I think as the generations age, needs change. So I'm curious what that is when it comes to the Gen Xers that you are working with. What's the biggest factor that differentiates them from your baby boomer clients?
Yeah, that's a really good question. And we're in a really unique period right now. We call it the Great Wealth Transfer. It means that, baby boomers, that generation actually holds the majority of the wealth in the country. And they're reaching the age to where they're going to start, and they already have started, passing those dollars on to their kids who are the X generation. And that's going to continue into the millennial generation. It's projected that it's about, or maybe north of, $120 trillion over the next 20 years that'll be passed on to these next two generations. I was talking with Dave and Jen just last week, and I asked them, and we met for the first time, and I asked them what their concerns are. And Dave brought up something really interesting. He said, navigating inheritance. And I thought that was brilliant how he kind of framed the process of inheritance and estate planning. They're going to inherit several $1 million. And as we went through in discussions, we figured out that, their parents, who they're going to be inheriting money from, they might not necessarily have everything set up to make sure that everything passes and transfers efficiently. And so we actually scheduled their parents, in addition to them, to come in and have some discussions and just make sure that everything is sitting right. It's projected that through this great wealth transfer, there's going to be billions of dollars lost because of planning mistakes and just poor transfer strategies. And the beneficiaries of those losses are going to be federal and state governments. So we certainly didn't sign up for that. I can't say enough how important having an estate plan in place is. It can be the difference of hundreds of thousands of dollars of taxes. And some people, depending on the situation, might just need a simple living trust. And then there's other situations where we might require multiple trusts and multiple strategies. But I encourage our listeners to get counsel and be sure to think about your parents as well. And I should note that this is one of those things we tend to procrastinate on. But that's not a good idea, especially in this situation. We all know life can change overnight.
Yeah, we have opened up those 5 spots on the calendar just for our radio listeners today with $500,000 or more saved for retirement. So give us a call right now. Let's set up a time for your initial phone conversation with Sean. This is a no-fee, no obligation initial step in your planning process. So again, that number to reach us, it's 559-847-0039. If you are 5 to 10 years from retirement, this is where you are really going to see the power of this kind of planning really take effect for you. We want to show you what Mason Street Wealth Management can do for you. So let's put a time on that calendar for your initial assessment with Sean. 559-847-0039 or MasonStreetRetirementInsights.com. All right, Sean, so we just talked about what Gen Xers are worried about when it comes to retirement, and their fears are pretty normal, it sounds. According to a recent study I saw by Allianz, nearly half of retirees are anxious about spending their savings. But what's one way to overcome that? Financial planner Kevin Lum says we should look at an income annuity.
Annuitized income won't maximize wealth, but it can maximize spending confidence. The average person with an annuity spends twice as much money as someone with a similar portfolio invested in the market. Now, the portfolio owner ends up richer, but the annuity owner feels more secure, even if they end up with less money.
So I thought this was very interesting, Sean. I wanted to chat with you about it. Have you seen this with some of the clients who come in and see you at Mason Street Wealth Management?
Yeah, for sure. And it's a really important dynamic, how people feel when they come to that realization that they don't have the paycheck anymore. I recognize, and I'm generally speaking, but I recognize a stark difference between the families we started working with before they retired and the families we meet after they retired. There's often a sort of uncertainty, concern, a feeling of not knowing in people when they retire without a comprehensive retirement plan, and understandably so. And the result is usually that fear of spending. It's one of the greatest injustices I see. We work all of those years, they deserve a certain quality of life, and instead they live less than. If you know my story, you know why I'm so passionate about what I do. I watched my mom suffer with the same feeling, and I had to fix it. When families go through our financial planning assessment, we use a specific methodology, and it's called RISA, Retirement Income Style Awareness. It really helps me in the planning phase, but more importantly, the family I'm working with, it helps them to identify the income strategy that will give them the most spendable income, but more important, give them the peace of mind that their lifestyle will be as they expected without worry. And for most of us, that's the goal. A stress-free retirement with the lifestyle we expect. I've found that when people have clarity in where their income is coming from, they'll feel confident in spending that income.
So you mentioned RISA, Sean, and I'm wondering if you can talk to us a little bit more about how RISA works and how it can help people who maybe are a little nervous about spending in retirement, or if you have any recent examples of clients that you've worked with who this methodology has helped them end up spending more and living that quality of life that they're used to.
Yeah, it's and the RISA is really a really powerful tool that we use. It really helps us dial down into who somebody is and what they want to accomplish. There's risk in different income strategies. And you've got to figure out what type of risk each individual person and family is willing to take. I was meeting with Steve and Carol. I was meeting with them for the first time, and this was, 6 or 7 weeks ago. And Carol began to explain to me that she was really concerned about not being able to do the things that she had hoped to do in retirement, and actually things that she and Steve had dreamed of together in doing. And she went on to explain that the reason for that is Steve is so worried about running out of money that he's not allowing them to spend any of the nest egg that they have accumulated. And Casey, it's more common than you can imagine. And that type of fear affects the whole family. I find that when somebody has comprehensive financial planning, it can really change things. So we decided together that we would design a comprehensive financial plan for them. And as we walked through the RISA methodology, that retirement income strategy, it was really neat to see. You could see Steve, how he changed the way he felt. We used some of their savings to position a lifetime guaranteed income. That's what Kevin was referring to. A lifetime guaranteed income to supplement their Social Security. And then we also positioned a long-term healthcare strategy. And those strategies really gave them the confidence that their necessities would be funded throughout their lifetime. And so that also gave us confidence in utilizing some of their money in the market in some strategically positioned asset classes so that they could use those dollars to fund lifestyle and their bucket list. And it ended up being a lot of fun. As we went through that, you could watch Steve gain clarity, and he actually started to ask us to model in additional lifestyle spending. And then to look over at Carol and see her smile with such a joy was just so priceless. In fact, Carol called me last week, and she was telling me how they were just in the middle of planning an African safari trip for next year. And so it's just another example of how comprehensive financial planning can really change life for people.
Yeah, if you've got questions about how guaranteed income could fit into your retirement plan, we have opened up those 5 spots on Sean's calendar for our radio listeners today. 559-847-0039 is the number to dial. And it all begins with that initial phone conversation with just you and Sean to talk about your questions, your concerns, what you're worried about when it comes to your retirement income. He'll then share with you his ideas on how he and the team might be able to help. And then we'll continue that conversation as far as building you a plan and all the other things that you've got to consider for your retirement. 559-847-0039 is the number to dial right now. And quick reminder, this is an opportunity for our listeners with $500,000 or more saved for retirement, and space is limited. So let's act fast. Go ahead, give us a call, 559-847-0039, or online at MasonStreetRetirementInsights.com. Scroll down to the bottom, plug in your info, and we'll have a Mason Street teammate reach out directly to you to get connected. Sean, thank you so much, as always, for breaking it all down for us today. You and I will be back next week, same time, same place. We're going to do it all over again. We'll have more retirement insight for Fresno. But until then, I'm going to hand it back over to you for our final word today.
Yeah, it's been a lot of fun, Casey. I love hanging out with our community. I want to remind everybody that we provide a lot of education out into the community, and we teach a lot of classes. And so go to our website and look up the classes that are coming up. You'll see different topics that you may be interested in, and then you can sign up there. But really, you got to keep tuning in every week. We so care about your success. We want to help you make it great. And we're going to keep bringing you the information that you need to make the right decisions moving forward. So we'll see you next week.
Mason Street Wealth Management, MSWM, is a registered investment advisor, and the opinions expressed by MSWM on this show are their own and do not reflect the opinions of Motivate Investments. Registration is not an endorsement by securities regulators. Investment advisory services are offered through Motivate Investments, an SEC-registered investment advisory firm. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. By contacting us, you may be provided with information about insurance products, including annuities, offered through Sean A. Mason, California, insurance license number 0B54860. The firms are separate entities. Annuity guarantees rely on the financial strength and claims-paying ability of the issuing insurance company and are not offered by Motivate Investments. Read your contract for restrictions, limitations, or penalties. MSWM is not licensed in all 50 states. To find out if MSWM is licensed in your state, please call 559-892-0002.